Okay, ladies and gentlemen, welcome back to video 2, where we'll cover our second financial statement, the balance sheet. Now, second to the income statement, and this is perhaps just one guy's opinion, second to the income statement, I would value the balance sheet as the second most important statement for us to really understand, to gain an appreciation for how financially strong the organization has been, especially as we start looking across multiple periods and accumulation of both assets and liabilities. So I'm going to take the next few minutes to unpack what the balance sheet looks like, what it can do for us, really kind of what it shows, and really how it can help us to gain an appreciation for how strong or weak an organization is. So again, not to reiterate the obvious, but the income statement formally told us about operations and profitability. What the balance sheet tells us is how much we have in terms of assets within an organization, as well as how much we have in terms of liabilities and ownership stake or owner equity in the business. Okay, so it's called a balance sheet because it must balance. Either we're in we have assets that will offset all of our liabilities and any sort of ownership stake that an individual or series of or group of individuals might have in an organization, or it's going to have more liabilities, fewer assets, and we'll end up with a negative equity position in some cases. Most of the time, though, we'll see that assets equal liabilities plus owner's equity. And the basic structure of the balance sheet looks like this. Typically, you'll see it left versus right, with assets on the left and liabilities and equity on the right. Sometimes you'll see it configured top to bottom. Assets will be on the top, liabilities and equity be on the bottom. But within each structure, you'll see that on the asset side as well as on the liability side, we'll have what's called a current set of assets and a current set of liabilities, and then a long-term set of assets and a long-term set of liabilities. And we'll unpack what that really means here in just a second. Okay, but like I said before, the balance sheet is called that because it must balance, where our assets equal liabilities plus equity, and we call that the basic accounting equation. Okay, now of course we can change things around and figure out, well, how much equity do we have? Well, of course, that would just be our assets less our liabilities, okay? But for the most part, we're going to be tracking, at least as we're starting to diagnose or really investigate an organization through its financial statements, we're going to be looking at the assets and the liabilities and the sources of those liabilities as we really start to understand, again, how tenuous or how firm the financial structure is for this particular organization. So it's also important to understand that depending on the type of organization, the balance sheet can look slightly different. Now on the left-hand side of our screen here, we have the for-profit. On the right-hand side, we have the not-for-profit. Everything looks pretty consistent until we get down into the stockholder or the net assets section, basically the owner's equity section of the balance sheet. Of course, with for-profits, it pretty much has our standard look. We have the amount of common stock, any sort of additional paid-in capital, and retained earnings. On the right-hand side, though, when we start talking about not-for-profits, you'll see it framed in terms of fund accounting, okay, where we basically have unrestricted funds that the board and the executive group of the organization can use at will. And then we'll have temporarily restricted as well as permanently restricted funds that were either donated or fenced off for some specific purpose or some legal restriction that must be adhered to by the organization. Okay, so don't get hung up on, depending on the type of organization you're looking at, there will be some slight nuances within the balance sheet that we just need to understand. Now, to follow our same or similar example that we did with the income statement, here we have just a very basic structure of the asset side of our Tiger Clinic. Okay. Again, we have the 2014 and 2015 reporting, and we have our range from top to bottom, current assets, all the way down through our total asset structure. Now, same as what we did with the income statement, we can look and do some comparison shopping between 14 and 15 and start to gain some understanding of where this organization is going through the financial statements and what it's actually telling us. So for starters, we see that there's quite a jump in our cash position from 6.4 million to just over 12 million through the course of this last year of operations. We've also seen a sizable jump of short-term investments. We've seen a nominal growth in terms of net patients accounts receivable, and our inventories have gone up slightly as well. Long-term investments have taken a large jump, from 25 to 48. And the rest of the sheet here is pretty unremarkable. There's a little bit of growth in net fixed assets. And we have, again, a pretty sizable jump from our total asset line from 115 million to 154.8 million. Okay, so it starts to form a little bit of a question in the back of my mind, at least, of, okay, so what happened? Where did we get all this additional cash? Especially as we've seen a pretty sizable growth from net patients account receivable. So as we look at the liability side of our balance sheet, we see current liabilities, notes payable, not that large of a jump. We actually see a decline in accounts payable, which is a good news story. We have less basically on account that we have to pay out to vendors, and a little bit of growth in our accrued expenses, nothing too out of the ordinary. However, as we look at our long-term debt, this is where we see the reason why we have such a large jump in our cash position, where we go from 53.5 to 85.3 million dollars in long-term debt, which tells us should, or at least is indicative, that we've had a pretty sizable bond issue in terms of a long-term debt, a long-term liability that we've been able to distribute across our asset side of the balance sheet. So that explains why we've seen this large jump, and again, those numbers should look familiar because this is the balance sheet, therefore it must balance against the asset side. Now hopefully what you've started to recognize is there's this same, and like I mentioned before, the same similar terminology with this term called current. Current simply means, in our utilization here within the accounting and the financial structures, current means within a year. So when we talk about the asset side, anything that's a current asset is either already cash or can be turned into cash within a year. So again, from the current asset perspective, as we talk about within the next year, short-term investments include marketable securities, perhaps CDs, or short-term CDs in particular. Our patient accounts receivable, hopefully, can be turned into cash within a year. If not, we're in real trouble. And then inventories, And on the balance sheet, you'll notice that in the current side, we are listing those assets in order of liquidity. So of course, cash being the most liquid asset is listed first, and then we go all the way down through inventories, which are listed last, simply because it would take us quite amount of time to turn something that's in our warehouse into liquid cash, either through sale or other means. And that's exactly what here we have on slide 42. Now it's important to also recognize that we don't particularly like to see too much cash. Now there's some notable exceptions out in industry right now. Apple and Google and others come to mind, what they're going to do with all their cash. Truth of the matter is they don't have enough places to put that cash, so that's basically sitting in reserves, which is a terribly good problem to have. However, for the rest of us, we don't like to see a lot of cash position above and beyond what we might need to maintain current operations. We like to see our cash moved into areas and projects and investments that are going to actually generate a return for the organization. One notable measure of cash that we typically use is this concept of net working capital, which is simply the difference between our current assets and our current liabilities. And I haven't gotten into it yet, but current liabilities on the liability side has the same sort of time boundaries we have on the asset side. So any current liability is something that must be paid within the year. Now the difference between current assets and current liabilities is what we call our net working capital, or how much liquidity do we have within the business to be able to maintain operations, keep the lights on, pay our employees, and so on and so forth. So just graphically, that's what that looks like. For some folks, that might make a little bit more sense as we see our asset line hopefully is larger than our current liabilities. And then that differential, that delta between the two, is what we term our net working capital. Okay, so again, cash is the actual cash on hand. That should be fairly intuitive. Short-term investments might be, we often term it as marketable securities, are highly liquid, low risk. Could be T-bills and any sort of other short-term security. Okay, it's important also to note on the balance sheet, and we talk about securities in general, are reported at cost. Okay, but we typically will reflect any sort of current market value down in our footnotes. So this creates a little bit of a nuance, and it's not just with respect to current assets, and it comes up in several different areas within multiple or almost all industries. If you have any business that has been in business for quite some time, it may have acquired an asset and it's being reported at cost, but of course that asset has appreciated substantially over the course of the last 50 years or 100 years, whatever, and because of that, the actual market value is much, much higher, okay, which basically tells us that the reporting process, as we see on the financial statements, might very well underrepresent what we have in terms of an asset within our ownership portfolio. Okay, so just be aware of it. This is why it's always important to read the footnotes in any of your financial statements, any of your annual reports, because you really learn a lot about what the organization has done and really the true value, and both on the good and the bad side of whatever has happened. Okay, inventories. We've mentioned this before. Inventories is the last section of the current asset line, or current asset section rather. And what we're reporting here on the balance sheet is basically anything that has been carried in inventory, it's been purchased in the past, but has not yet been expensed out on the income statement, or has not been pressed into production, so to speak, or in patient care. Okay. And so what we do is we record that on the balance sheet. Now, in the modern era, we like to see inventories be lower and lower than what they once were. That's a large portion of, in fact, if you follow lean manufacturing or lean processing, inventory is actually one of the 7 deadly forms of waste. If you recognize that term, there's an acronym for it, TIMWOOD, transportation, inventories, motion, waiting, overproduction, overprocessing, and defects, right? That's the TIMWOOD acronym. Well, the I in that, and we start to look at inventory, is really a form of waste, because inventory, of course, has to be heated, cooled, insured, protected. And the costs go, higher and higher the more inventory that you have. So what we like to do is we like to see inventories coming down in the modern era, but of course there's always going to be inventory of some sort in any healthcare enterprise, especially as we start to consider safety stocks and making sure that we don't have a stock out. Now, it also might mean that we're going to be doing something a little bit different than what we've done in the past in terms of who supplies, how often they supplies, or whether we need to own that inventory or whether the vendor can. But again, that's a discussion for a different time. But this is where and why we actually record inventory on the balance sheet. Now, long-term investments are investments in securities or any financial asset, as opposed to buildings that are real assets that have maturities greater than 1 year. Thus, the term long-term versus a current investment. And then property and equipment, any fixed asset or real asset having a useful life greater than 1 year. Okay, important area, just to kind of gain some fidelity with what the ratios that we're going to talk about in a little bit can do from a balance sheet perspective. And it's one area that I'm actually using in some research right now, is this concept of age of plant. Anybody that's taken any accounting probably has come across that term in the past, but what we're really talking about in this case is how old our infrastructure is. Okay, so we can take that accumulated depreciation, and look at basically the depreciation expense, and come up with basically an age of plant in years that shows us how old that infrastructure is. So then the question is actually what we're looking at in our research right now is, does that aging facility have any sort of impact on nurse turnover, nurse retention, provider attraction, or provider loss? as well as downstream profitability and downstream patient safety and quality scores. One would presume the older my infrastructure gets, I'm going to have more of a problem in all of those areas than if I have a brand new infrastructure around me that not only attracts patients but attracts all the provider and clinical staff as well. So anyway, sidebar conversation for another time. Now, on the liability side, we're really talking about a liability being anything that is fixed by contract, a claim against our organization that is fixed by contract. Okay, if we fail to meet our our claims, can result in a bankruptcy or potential closure. Okay. Now, different types of liabilities that we're going to talk about here in a little bit. Okay. We're going to have accruals that are owed to our workers, employees. We're also going to have vendors that we have to pay for the services or for the products that they provide. We're also going to have to include creditors that provide the debt capital necessary, at least on both on a short and a long-term basis. Okay, so like we've talked about on the asset side, current liabilities are those obligations that are coming due within the year or must be paid within a year. Okay. Most common ones that we're going to see are notes payable, accounts payable, accrued expenses. We'll talk about each one of those here in just a second. Starting with notes payable, short-term debt obligations, typically a bank note or a bank loan. Okay. Maturity of less than a year, and what we'll typically see is a line of credit. Okay. Now, line of credits, at least lines of credit, in my experience, never go away. We're always going to have a line of credit available to us if we have a good working relationship with a local commercial bank. Hopefully that's in place, because when we have short-term liquidity needs, for whatever reason, we like to be able to tap into a line of credit without jumping through a whole lot of hoops in order to do so. So that notes payable, that line of credit, really provides us that margin, if you will, to be able to meet short-term obligations. Now, if we're constantly tapping it and that balance is growing higher and higher, of course the commercial lender is going to be interested, and that's not a long-term strategy for good fiscal health. Okay, it's kind of like continuing to put expenses on your credit card. Okay, has the same sort of implications for an organization as it might for an individual. So anyway, so that line of credit is not going to go away. It's going to fluctuate higher or lower depending on the most recent short-term needs. But it's pretty ubiquitous in terms of always going to be there on our statements. Okay. Now, accounts payable again is another line item that will never go away. Okay, because we're always going to have accounts, as we talk about this being a snapshot in time. Always going to have accounts that have not yet been paid off. We're not going to have yet satisfied. And if we're really talking about managing our cash position very well in terms of working capital management, we're going to try to be fair with our vendors and with those who we have accruals with, okay? But we're going to not pay them right away because the money is better off in our coffers than it is in somebody else's, okay? So that's part of the discussion we've had in other areas with regards to trade credit, the terms of 210 net 30 and the calculations thereof that we've covered elsewhere. But anything that we have not yet paid is considered an account payable, and it's carried on the balance sheet as such. Accrued expenses are things that basically by virtue of going through operations, we are just going to accrue and have to owe somebody for the services or the product that has been provided. Okay, it also includes really fun items like taxes that must be paid to government authorities for doing business within a specific period of time, as well as interest payments to any sort of creditor. Okay, so in this case, let's say I get paid on the 1st or the 2nd and the 5th, and the 2nd and the 30th, or I don't know, no, that's not right, 2nd and 15th. If once we reach the end of the fiscal year, the organization owes me basically for the last half of December in terms of payroll, right? Well, I'm not going to get paid until the 2nd of January, so what the organization owes me is considered an accrued expense in terms of salaries payable, okay? and of course it will be reflected at that snapshot in time at the end of the fiscal year, or at least the end of the calendar year, that must be reflected on the balance sheet as an accrued expense. And we're going to have other forms of spontaneous liabilities, and part of that is just due to the size and volume of performance that we have within an organization. And truthfully, depending on the size of the organization, those spontaneous liabilities, that grace period you have with regards to how long you have to pay a vendor if cash is not required immediately upon delivery, is a really big source of funding for growing businesses, or those especially in the startup phase. Now, that's all short term. On the long term side, we have any sort of debt instrument, any sort of debt obligation with maturity greater than a year. Okay, so for smaller organizations, long-term credit from commercial banks, large bank loans, or a term loan can be considered a long-term debt. For larger organizations, especially hospital systems, you're going to see this in the form of a bond, which we've talked about previously. Okay, now again, little sales pitch for use of the footnotes. A lot of information on these sorts of long-term debt obligations are disclosed in the footnotes, okay, sometimes with dizzying sort of granularity. I still encourage you to investigate those footnotes and make sure you know what they say, especially if you're going to be either doing business with or investing in the organization, either on a personal or professional level. So that's the asset side, the debt, or the liability side. The last portion of the balance sheet we need to talk about is the equity section. Okay. Now, of course, depending on whether it's a for-profit or not-for-profit, there are some nuances, there are some differences that must be understood. Okay. On the investor-owned side, equity is the amount of owner-supplied financing, and owners can take many different forms, either as the original owners or, of course, any stockholder of various types, both preferred stock, common stock. Okay. On the not-for-profit side, equity is basically that portion that is left over, if you will, after assets or assets have covered all of the current and long-term liabilities. Okay. So again, back to the accounting equation, equity is that remainder, or sometimes it's termed the plug, that plugs the difference between the assets and liability lines. Okay, so sometimes, especially in the not-for-profit side, you'll see that basically equity is called net assets, or the dollar value of assets net of liabilities. Don't get confused. Just know that the basic structure is there. It just might have a slightly different name than what we might otherwise use. So as we look at the equity section, it can be a little bit confusing, especially on the for-profit side. In fact, I would argue that the not-for-profit side is a little easier to understand, especially if we understand the different fences and types of funds that are being used. But on the for-profit side, we'll see things like this that we have on the page. We start talking about stockholders' equity and common stock at $1 par value and 1.5 million shares authorized with 1 million shares outstanding. Frankly, it's all kind of trivial, sort of. I mean, it's not trivial, but it's not really something that you need to spend a whole lot of time with. The only things you really need to draw out of this is how many shares have been authorized, basically on the initial, what am I trying to say? The original investment banking agreement, when the organization goes through the IPO process and actually decides that it's going to divvy up the number of basically ownership shares within the organization. So in this case, we have 1.5 million shares authorized. That's the total pot of shares of the organization. Right now, 500,000 of them reside within the organization. We call that treasury stock, or stock that has not basically been released to the public. And we have 1 million shares out that are outstanding or out in the secondary market in various different holdings, whether that's a mutual fund or individuals that basically carry that. Now, the valuation of this really doesn't bear a whole lot of meaning. Typically, in order for a share to be authorized, it has to have a par value or a face value on the share or the stock certificate. So that's fairly it just has to have some sort of value. So any capital in excess of par basically is any additional capital that has been contributed in order to basically fund the organization from the equity side, if that makes any sense. The remainder, though, basically between what we've got in terms of total equity less these amounts, is what we have called retained earnings, or those earnings that have been accrued over time, either both during the last reporting period as well as periods before, the amount of equity that's been accrued to the owners of the organization. Okay, so for a little bit more clarity, I encourage you to click through on this link that kind of breaks this down in much more granular detail than what I've done. But the main thing you need to get out of the equity section is this is what's left over after we've satisfied all of our liabilities. And hopefully this is a positive number. When it's negative, that means that we owe more, right, than we have assets to cover. And that's typically an organization, one could argue, is not long to be in operation. Okay, but it has happened where organizations have turned it around and done just fine too. So, but it's not a position we like to find ourselves in. Okay. The other side, that the issue that I don't know if I want to put this under the equity section necessarily. The important thing to understand about the balance sheet, especially as we look at the right-hand side of it, is it helps us to understand how much debt and how much equity is being used in order to finance the assets that we have on the left-hand side. Okay, so each one of these has a little bit different risk profile. Of course, more equity that we have in terms of financing the overall structure. That means that they're probably, we're on the plus side at least, we're going to have less in terms of debt service payments. The organization is going to be slightly more nimble as long as all the shareholders are getting along well and we don't have any sort of difficulties in terms of agreement there. But essentially the carryaway point here is that right-hand side of the balance sheet gives us an idea of the overall capital structure of how our organization is financed. Okay, and again, pluses and minuses on both sides of whether there's an argument, well, we don't want to use any debt at all. We don't like to owe anybody anything. Organizations that do that typically will find themselves unable to grow as fast as others that are able to effectively leverage, and there's the term that we often use, leverage other people's money or other organizations' money to help finance our growth. As long as we're borrowing for a good purpose that's going to generate return on investment or return on invested capital that can help us to move forward. When we're borrowing just to maintain operations on the status quo and just to keep the lights on, that's where an organization is really digging itself into a hole. Okay. Wanted to touch just a little bit on our last section within the balance sheet, kind of discussion, is this issue with fund accounting. And again, when we start talking about not-for-profit organizations within the equity side, realize that you're going to have some funds that are going to be unrestricted, where the ownership team, or the leadership team, the board can basically use those resources, move them where they need, basically at will. Then you might have temporarily restricted, and you might have permanently restricted funds as well, that again are fenced off by virtue of either donor intent, donor specification, or some other legal structure that's basically restricting the organization from tapping into that particular set of funds for any other purpose than what was originally specified. Okay? And you can do a Google search on your own, find fairly quickly organizations that have done exactly that and have gotten into some pretty hot water, either with the donors or the donor's family, and they're wanting to claw that money back because it's not being used as originally intended, or for legal implications, for a multitude of reasons. So encourage you to dig into that if you're curious about it. Also invite you to click through on this particular link that talks about the different sorts of non-profit, basically fund accounting, in a little bit more detail than what I can offer here. So with that, thanks for your attention on the balance sheet, and we'll pick up here in just a second with the statement of cash flows.